All right, we are picking up on chapter 5. Just want to give a little bit of warning. If you did not understand chapters 1 through 4, you will have a very hard time understanding chapter 5 all the way to chapter 10. Okay, so if you still feel a little bit shaky on that knowledge, please go back, watch videos again. Try to make sure that you get that foundation on chapters 1 through 4. All right, so chapter 5, we're picking up on merchandising operations. And this is very different than anything we've done in the first 4 chapters. We're looking at a kind of a different type of business. Chapters 1 through 4, we were looking at service-oriented businesses. We weren't looking at inventory for any of those businesses. Like we were looking maybe an engineering firm, a law firm, a CPA firm. All of those places provide a service. They're not necessarily selling an inventory. Okay. So we're going to do one video on 5.1. We will combine 5.2 and 5.3, and we will combine 5.4 and 5.5. Okay, not going to really go into 5.6 because that has to do with a ratio that I've been telling you. We're going to kind of wait until we get to Principles of Accounting 2 to talk about ratios. Okay. And some of this other stuff, they are talking about a periodic inventory system. We're actually not going to cover that because most businesses do not use periodic inventory anymore. They use perpetual. Okay. So you will understand the difference between those two here really quick. All right. So learning objective 5.1, we are looking at a merchandising operation. We are looking at something like Walmart, Kroger, or Target. Okay. All of those type of businesses carry inventory, and that inventory is then sold. Okay. So we call those merchandisers because they have stuff in a store or in a warehouse ready to sell. Okay. If you are thinking about your balance sheet, let's come over here and draw this out really quick. Assets equal liabilities plus owner's equity. Merchandise inventory is an asset. More specifically, it is a current asset. Okay. It is a current asset because we expect to sell all of that inventory within one period or 1 year. Okay. A wholesaler will buy goods from a manufacturer and then sell to retailers. Okay. The retailer is going to buy the merchandise from the manufacturers or the wholesalers, and then they are going to in turn sell those goods to the consumers. Okay. So, how does the operating cycle look for a merchandising business? Well, it starts out, it has to purchase some inventory. It purchases some inventory from an individual, a business. Most of the time, we call that a vendor. Okay. Then the company is going to sell that inventory to a customer. Okay. Finally, the company is going to collect the cash from the customers. And this could be one of two ways. We could collect it in cash or we could have an accounts receivable. Okay. So you see this little diagram where they have purchase some inventory, sell the inventory, collect the cash or accounts receivable, and then we're going to just keep on doing this over and over and over again. And businesses like Walmart don't necessarily make a lot of money off of each sale. It's the fact that they generate that sale of a particular item a million times. That's where they make their money is in the volume. Okay. So, some other accounts we are going to talk about in this chapter. One that's going to be on our income statement is going to be the cost of goods sold. I abbreviate it COGS, COGS. That's very common outside of the accounting classroom for other people to call it cost of goods sold. Okay. This is an expense. Remember, I said way back in chapters 1 and 2, most of your expenses are going to have the word expense at the end of it. Supplies expense, um, rent expense, wages expense, salary expense. This one does not necessarily have expense at the end of it, but it is an expense. Okay. Gross profit is not necessary. It's not an account. It is just the sales revenue minus the cost of goods sold. So let's just say We walked into Walmart and we bought a bag of chips, and the sale of those chips was $5. But it probably only cost Walmart, let's just say $2. Okay. That cost of goods sold, let's just say it cost them $2. Gross profit is just the difference between the two. Okay. We're going to look at a different income statement for this chapter as well that will illustrate this. So gross profit's not necessarily an account. It is just sales revenue minus cost of goods sold. Then we have all those other expenses outside of cost of goods sold. Those would be things like your rent expense, your salaries expense, things like that. Okay. So we're going to look at the financial statements of a service business. This over here looks very familiar, right? That's what we've been doing up to this point. That's our income statement. We just have revenues minus the expenses. We get net income, and that's the only total we have. Okay. For a merchandising business, their income statement is going to look a lot different. Okay. We're going to start with this net sales revenue, and we're going to subtract that cost of goods sold out to get that gross profit. I just illustrated that in the previous problem. So we have this number here that tells us, are we making money buying and selling stuff? That's all we're doing here. No other expenses or anything else. Are we making money buying and selling stuff? And you would hope, if you are the merchandiser, that you're going to be having more sales revenue than cost of goods sold. Because if you're in the wrong line of business, if your cost of goods sold is higher than your net sales revenue, okay, you're selling things at a loss, not a gain. Okay. All right. There's that gross profit. It's just a total on the income statement. It's not an account. Okay. Then you have all your other expenses. Now we have salaries, rent, depreciation, utilities, and then we get the total uh, operating expenses. And then we get net income. Okay. This number comes from gross profit minus the other expenses, the other operating expenses, and that will give you net income. Okay. These were not the same companies. But if you notice, the only thing that was different about these two companies was the cost of goods sold over 100,000. So that's the difference between those two net incomes. Sometimes they'll do an income statement both ways, and they'll both get net income. Okay, and you can do that if you did. This is called single step. Okay, single step, and then this is multi-step. Okay, so it gives us more information. We get these intermediate totals, but most of the time our net income is going to be exactly the same. They just didn't use the exact same numbers for both of these examples. Okay. But if you were given a problem in the book to do, then, and it told you to do it a single step and a multi-step, your net income would be the same. Okay. All right. What's the balance sheet going to look like for a service business? You're kind of used to this right here because we've been doing that. The only thing we're adding in a merchandise setting is we're adding that inventory line. And if you think about how much inventory is just in one Walmart Supercenter, not all the Walmart Supercenters, every Walmart, every neighborhood Walmart, every Walmart warehouse, that's a lot of inventory. They probably have more money tied up in inventory than probably any other asset, especially cash. Okay. So that usually makes up a huge, huge part of a merchandiser's current assets. All right. I mentioned to you at the beginning of this lecture that we were not going to do periodic system. I'm not going to go through the journal entries and the calculations under periodic. I just want you to know definition, what it is. Okay. Think of periodic as more of, if you think about no computer system, is what I usually think of. No computer system. Okay. These are like small mom and pop gas stations. They don't have a lot of inventory. They have not sunk the money into like a barcoding system like almost everywhere has. And now most even small gas stations have some sort of scanner that they're scanning that. So they're keeping up with inventory all the time. Okay. When you think of perpetual, that is what we're thinking about. Okay. Think of a computer system because it would be really hard to run a paper and pencil inventory system under perpetual. Because if you think about it, every time you walked into Walmart, there's a sale. Okay, they'd have to make a journal entry for sale manually. They would have to make a journal entry for how much those goods cost. That's just one good. Think about when you go to Walmart and you buy 100 different items. That journal entry would have to be taking out 100 different items, but the computer system does it for us. Okay, so periodic is just not dealt with very much anymore. So that's why they've put it in an appendix to the book. If you are going to be an accounting major, we do touch on it in intermediate accounting because you do still have to do some of the calculations for periodic inventory, but chances are probably none of y'all are ever going to see a periodic system. You are going to see a perpetual system. Okay. And it's really interesting if you think about everything that happens. I use Walmart a lot. It's not my favorite place, but Walmart's very good with using technology. So every time you go in there and buy something and you scan it, and I like the self checkout. If you go doo okay, lots of things are happening. It's ringing up a sale and it's automatically taking it out of its inventory. Okay, there's probably other things going on, but there's also these predetermined inventory levels. So if the inventory drops to a certain level, an automatic purchase order is sent to that vendor and says, "Hey, we need more Cheetos or we need more Doritos. Okay, bring us some more." And the only thing that happened was just that item being scanned. Okay. So, and that is one reason Walmart has been so successful is because they have embraced technology in every aspect, ever since the beginning of Walmart and it being a brand new business. And so, okay. All right. That's all for Objective 5.1. I will see you all in the next Objective video 5.2.